Chris Frostad. How are we today, sir?
You're great. Thank you, Matt. And yourself?
Not too bad, not too bad. Not so bleached out this week. Right, we are going to talk about. We're going to sort of say sorry to the Red Book. We had a bit of a go. Well, I was ranting a bit, and like a crazy ex-wife, she wasn't all bad. So we're going to apologise slightly for bits of it, but not all of it. Does that feel good? You feel better?
Yeah, a little better.
Yeah. Okay. So what are we talking about? So the whole gist of these conversations is really kind of highlighting the kind of resurgence of the nuclear energy sector and its contribution towards clean energy transition and its kind of role and uranium's role in that, obviously. So we got to look back before we can look forward and try and understand what's gone on. We talked last week about the kind of supply challenges that are there, and we'll touch on a little bit of that today. But the thing is that there's a bunch of other things that we can point to. So if I go back to post Fukushima, so I'm going to go 2011 through to say 2021. It was a kind of decade of decline, wasn't it? Wasn't nice to be around. You were there. Tell me more.
I was there. Well, yeah. I mean, uranium exploration fell off a cliff. Yeah. And now, I guess we're all standing at the bottom, wondering why nobody brought a ladder. Yeah.
So when you sort of talk to some of the things that sort of happened during that kind of decade of
well, we really missed a decade of exploration, and that's kind of the impetus of what happened back in the 2000s when uranium made a run back, because we were looking back and realized that nobody had done any exploration for the 20 years prior to that. And now we've just done that to ourselves again. So yes, during that year, I think the numbers the Red Book provides, we're looking at like an 80% decline in exploration spending over that time period. Went like from $200-300 million a year down to about $50 million a year. And it wasn't just the dial being turned down investment. It was companies leaving the space completely, redirecting themselves, rebranding themselves, getting into other commodities. Like people just left.
And that's it. But you remember, companies went from like 50 companies to about 450 companies, right?
That's right.
Pre-Fukushima. So post-Fukushima, something they needed a reaction there because there wasn't ever going to be enough money for all of those companies.
That's true. But I mean, it did pull all that cash out of the ground, and with that, it means that the exploration that's happening now isn't going to fix, our 2030 problem by any means. Because as we've seen, it's taken 10 to 15 years or more to bring a discovery through to production of any kind. So anything we find now is fixing the 2040 problem, not the 2030 problem. It just adds to the problem.
But it was more than just the companies leaving. It was the kind of skill sets leaving and moving on to other. Well, one, people aging and leaving because they're retiring, but two, so going to other sectors which didn't have this kind of erratic behavior. Yeah. And here we are today, suffering a bit from that. But what do you think is what do you see as this underinvestment is kind of How do you see this underinvestment affecting things today? Because there's a kind of missing generation of not just people, but also discoveries. You've talked about that before.
Yeah, absolutely. Yeah. So I mean, the people is not a small thing. I mean, the first go around 20 years ago, we were pulling people out of retirement because it's a small industry, and so it's a small skill base you're drawing from, and we've run into that again. And again, as we talked about last week, these companies that are developing mines now, these aren't the same people that were producing uranium 20 years ago, 30 years ago. So it's you've really got a new group of investors, or a new group of technical people, I guess, trying to bring these things on board. So it's really come back. It's come back in a way that it's for a lot of companies, for a lot of new companies, we can see that they're struggling in terms of the messaging, in terms of where to look, how to look. They're learning on the run, on the fly, and it's difficult. So we didn't just you say you lost all that experience as well, because a lot of stuff was determined over the last and understood over the last 10 years, 15 years that we didn't know before in terms of, particularly in the basin. The technology's changed, the use of that technology, where it works, where it doesn't, the geology, the depth, like all of these things that, we've ourselves and a couple of the few other companies that were around have been able to keep up to date on. A lot of these now we're setting up a lot of new companies that are learning on the fly, and it's tough.
So I mean, if you think about all the kind of the big producers. Obviously, you'll know a lot more about the Athabasca Basin and Canadian exploration than me. But Australia's exploration fell to under 10 million bucks by 2020, and they were the third largest producer. Olympic Dam, obviously, being a resource holder, I should say. They Olympic Dam being the kind of big part of that. When they stopped there, that was problematic. Kazakhstan, even their budgets decreased, and they were the global leader. They were the largest producer in the world. We didn't see much happening in Africa as a result. That was always going to be a tough one. It remains a tough one, if you ask me. So this kind of pre-COVID situation, this kind of mothballing and care and maintenance of a lot of projects. It needed such a big kick up the ass to kind of get it through COVID and out the other side. And we've talked about last week a lot about the kind of supply issues, but you can't have 10, 12 years of inactivity, lack of investment, lack of people, lack of interest, lack of political will, and expect to kind of respond as quickly as it needs to. And that's, I guess, clear from last week's conversation. That's where we find ourselves.
Right. Because we can't catch up. As much money is now being poured into the ground, and there's a lot more money now. I don't even think we're back up to 2012 levels yet, but we are. For all the money that's now being spent, you can't make up for 10 years. We can't fix that problem. And as we look forward, it's like the majors can't even fix the supply problem. There's a lack of where's their growth strategy in terms of product, and I don't think they're going to be the ones that fix it. They're going to acquire the juniors that have found something and will fix it. It's 10 years of inactivity that you just can't make up for overnight.
Right. Well, we're going to have to. we need to. That's a big part of our thesis. If I remember correctly, we expect there's got to be a kind of rebound in exploration budgets after this kind of decade-long underinvestment. We are going to have to deal with this kind of structural deficit of uranium that we talked about. So, should we talk about that kind of rebound? And it's not a rebound in the sense that rebound sounds vigorous, doesn't it? This is a very fragile rebound from 2021 to present day, because we kind of, because of the energy crisis we found ourselves in, post, certainly here in Europe, post Russia Ukraine invasion, gas prices going up across the board. There was no plan B. All of that going on, but that's definitely helped. We've seen spurt and all these kind of physical uranium trusts being set up. We've seen companies going to care and maintenance. We're seeing all the kind of big drivers that we've talked about for the last 5 years as being, this is it, boys, this is the catalyst moment. But it's been, I think fragile is the word I'm searching for. What do you think?
Well, we haven't seen the utilities panicking yet, I guess, is the problem. And I think we need to see these prices move and the money come back into the sector. I mean, a lot of money fixes a lot of problems. You can get things into production if you don't mind paying for it. And we haven't seen that re-rating in this sector yet. The ETFs are backing producers more than juniors. Analysts aren't talking about anything sub $100 million market cap. It really hasn't hit home yet. And in the long-term prices only just hit incentive prices. And that's even questionable whether it's an incentive price yet or not. So I think this all the noise we're seeing, all the stuff we're seeing, is building up for something that is, yeah, in the interim, it's going to be erratic. It's going to be volatile, maybe, but again, because it's a small market, when it does happen, it's going to happen, and I think it might be somewhat violent when it happens.
Right. Well, okay. So your point is well made. Basically, exploration budget doubled between 21 and 2023. So that's good, but still below 2012 levels. So that's not so good, right? Mm-hmm. So here's the apology to the Red Book, which we discussed last week, which is basically that kind of greenfield. It does say greenfield discoveries won't affect supply until after 2040, folks. 2040. Okay, let's remind ourselves that's the kind of scarcity environment that we're in, and the scarcity opportunity that as investors we are in. So from discovery through to production in the Athabasca Basin, historically 15 years. And that's pre-ESG, that's lot more power to First Nations and social license and all of those wonderful permitting and licensing issues that companies face and will continue to face. 15 years. So the scarcity is the opportunity here. So how do companies like the Fission, the NextGens, and the Denisons take advantage of those kind of, I guess, reactivation programs that you might call them, in that kind of environment? How do you take advantage of it?
Well, that's I mean, that question covers a lot of different people's problems. I mean, the NextGens, the Denisons, I think they're fine doing what they're doing. They have to find ways to, they're looking at financing their development and their construction aspects. I mean, that's kind of where they're getting to. They're at that end of the pipeline, and they're the ones that are going to have access to the first money coming in. It's the exploration side that's going to continue to have a challenge in communicating properly to investors and showing them what the value proposition is and explaining it, because it's we keep saying this, the underlying thesis hasn't changed for quite a while. It's a matter of timing. And when the time value of money in your investment starts to come into play, it's a question of what am I doing? So I think it's going to be different strategies for every single person in the club, and it's a small club.
I think that's part of the problem, is the fact that the underlying thesis hasn't changed in a long time. Because you kind of maybe we'd have lots of different theses, based on a 2-year, 3-year outlook, and a 5 to 10 year outlook, and a 15 to 20 year outlook. Because in investing terms, you're looking at the risk and all of the factors that can affect the kind of risk profile. There needs to be, I guess, more nuance to your investing when you're looking at a 15 to 20 year discovery through to production profile.
But you're not looking. That's not the investment thesis, right? Because let's face it, most of the money is made long before there's even from an exploration standpoint, the investor's money is made long before there's even a resource determined, right? You look at Hathor, you look at NextGen, you look at Fission, you look at UEX. All of these companies, we're going up 10, 20, in UEX case 1,000 times just based on drill results, because that's now you're looking at something that a major is going to have to pick up if it's going to see its way to production. So the mindset from an investment standpoint can't be I'm going to find myself a little junior who's going to find something and then turn it into a mine. That's not the game. You're in you've got to break that in two, and you're looking for exploration companies that are going to find the next deposit. And I mean, we're not guaranteeing that in the basin, we're not guaranteeing that we're going to find another Arrow necessarily, but we're certainly drilling in the only place that is capable of it. And when that happens, that's the payback at that point in time. That's when an investor.
Yeah, well, that's what I'm saying. You need a few theses here, which is the 2-3 year, or the 5-10 year, and then the kind of 15 to 20 year theses, right? So I think we're in violent agreement.
Oh,
so for a change.
That hurt. Yeah,
for change. Yeah. Okay. So here's the big question then. So how much money? Given we're saying that we're not even at 2012 levels for the kind of global spending on exploration, how much more money needs to come into the space to do the kind of exploration. And you did a show about this maybe a couple of months ago, maybe 2-3 months ago, talking about the amount of money that has been spent or needs to be spent to make a discovery, an economic, commercially viable discovery. It's a lot of drilling, it's a lot of holes, but as a sector, for the sector as a whole, how much money do you think, and where's it going to come from?
For a discovery on the exploration side? Well, I think the number I've been keep throwing around is it was $3 billion over the last 20 years. And we found 700 million pounds of uranium. So it's about $3 or $4 US a pound was the cost of discovery. But those were six deposits. And the glory was reaped by 6 or 7 companies. And so it's a lot of money. And I mean, and every time we drill a hole, anytime anybody drills a hole, it redraws the map out there. So we're constantly learning from each other as well. It's not just our own backyard that we're learning in. So how much money?
But those are also, just to be clear, those are pounds in the ground, right? The $3, right? So
yeah, that's a resource estimate.
Yeah, right, as a resource, which doesn't necessarily mean it comes out of the ground, which doesn't necessarily mean it's economic, right? Doesn't necessarily mean it's.
But those are, I mean, those are all. I mean, you know, you go back really early. You know, Denison's working on one of those 6. The Hathor one is now owned by UEC. They're advancing that one. Next gen fission, we know those things are moving forward. Where was my other ones? You know, ISO's hurricane zone. Something's going to happen with that one. There's a 6th one that's skipping my mind. So, you know, those are in the pipeline. Those are solid projects that presumably will see the light of day at some point in time. But most of them don't have timelines associated with them right now.
Because of what, permitting?
No, because of price, because of permitting, maybe because, you know, there's a variety of things. But it's not just the permitting by any means.
No, it's not just, but that was the kind of big sticky bit in all of this when I started talking to Canadian companies, and well, most recently 2019. It wasn't money. Money was always going to be around.
Yeah, but it was the price of uranium at that point in time. I mean, between 2012 and 2022, nobody was going to even consider putting a shovel in the ground.
Don't worry, those are heady days. We all had hopes and dreams and aspirations. Back to your unicorn from last week, where money was going to be available because the price of uranium would increase for all the reasons that we've been talking about for the last 5 goddamn years. But the one which people couldn't give me an answer to with any, you know, degree of enthusiasm was around permitting in the Athabasca Basin. Do you think that's changed?
Has it changed? It seems to be progressing at the same rate it always has. You know, Denison's theirs is coming along well. Next Gen's is coming along well. I don't think Fission's has started, or Paladin, I'm sorry. I don't think UEC started a permit, you know, the process. Maybe they have. A lot of it was them just not getting off their butts and getting that process going, because I think people were concerned that they were going to be stuck in the uranium rut, languishing, you know, price languishing for too long. You know, for all the optimism we had to continuously feed the market. You know, in the background, it's a lot of money that we're trying to figure out, and we don't have that kind of visibility like other investors did as to when this market was ever going to come back. So I think a lot of that just put a bucket of water on everybody's enthusiasm and urgency of getting a mine into production.
Right. And I guess the other question here is, if you look at the type of investment that has been going on since, say, 2021, it's into brownfield, not...
That's right.
Not new frontiers, not making new discoveries, etc. So again, what an impact does that have?
Well, yeah, a lot of that money has been going into discoveries that were made, or pseudo discoveries that were made prior to like 2016. And interestingly enough, when you look at some of the early investment, if we're going back to these developers, you know, a lot of the money going into next gen that went into fission was out of China, you know, and so they've been unraveling that to some degree as well. So there's a lot of the geopolitical issues are not completely gone in Canada. as to where that's, how that's all heading down the road.
We're seeing the same sorts of behavior in other metals as well. And the big companies want to invest in existing resources, existing reserves, and not take the chance elsewhere, because they're the ones being judged. Their share price on being affected by not having enough reserves on the books. They need to go and find those. What they don't want to have to do is go and find it, fresh out of the gate, because they don't have the time at the moment really to kind of play games.
Well, and even are they, talk about the reserves. Are the reserves really the reserves that are there? What the Red Book calls RAR, or what they're looking at, reasonably assured reserves or something to that effect, isn't always in jurisdictions where you're allowed to mine it. They're looking at just raw pounds in the ground, without the application of, and that's fair, but without the application of likelihood of, could it ever be mined? And so that, the reserves aren't there as well. So it'd be interesting, and maybe it was in there. I haven't seen it yet, but how much of this money that's coming into it now? Well, I guess it wouldn't be in the Red Book, is in greenfield as opposed to brownfield. There's a lot of money coming in the last 3-4 years, but again, it's on stuff that was found ages ago.
Yeah, well, look, I guess it's 2021, still dealing with the issues, supply chain issues, etc., and in a high inflation environment, and we're seeing a lot of cost overruns in a lot of mining projects, from exploration, development, and production, actually. And that I can see where that would put people, the industry off of spending money on exploration. I would see why I put equities investors off, having sort of had various false starts. We've lost a lot of money, right?
That was another aspect that came out of the Red Book, and we could dig into that at some point in time. But what was the rising cost of all of this? And that, where maybe the cost generically was in the $40-50 range before, it's now $80 plus maybe. It's the one thing, again, that the industry doesn't like to beat a drum and get all excited about, which is rising prices and costs. But in fact, that's what we're looking at, is, the easy stuff's been found and mined, and and prices just generally across the board are going up from a cost perspective.
Yeah, because it's a funny time, because the disconnect between equities and metal prices across the board. Lots of metals are complaining about that kind of parting of ways, as it were. But the reality is, in a normal market, any market, you've got whatever you're selling, and it's kind of find its level. So if your prices are too high and you don't have enough customers, you're not going to be able to make that margin. You're going to go bust. Likewise, in this energy complex of ours, I think uranium people, nuclear people don't necessarily understand the kind of the whole entire energy market and where this sits. Nuclear has to prove that it's cheaper to produce, or and it doesn't have those barriers to entry like a massive capex, which a lot of these utilities really don't want to have to deal with. And it's got to have a sensible argument about that. I think because I also talk to gas guys, oil guys, coal guys, renewables. They everyone's kind of got a good story as to why they need to be in here, and maybe we do need all of the above. But do you think that the nuclear and the uranium guys are telling a good enough story, other than, well, we don't have enough of it. We don't have enough of the nuclear component, but people are working hard on all the other components, and that's the competition, boys and girls.
Well, it's again, we talk about this a lot. I mean, it's the transparency into the market. I think the industry and the market is telling as good a story as it can based on the information it's got. And again, you go back to our discussion last week. If you're a few years late on your data, things are changing drastically. Those cost increases that they were already predicting, I'm sure, have gone up again drastically since 2021, which is the end of their data. Over the last 3 years, all kinds of things have changed. So it's a hard industry to keep up to in terms of the granular data that people really want to know. We don't know what kind of inventories these utilities are sitting on. We don't know where they're having trouble accessing or not accessing because they're on their telephones doing their deals. This is not something that's publicly available, sitting on an exchange somewhere. So we keep telling a macro story because that's really all we've got to tell. We've been producing less than we consume for 6 years now. We can't get uranium for United States can't get uranium from Russia or Kazakhstan anymore. Like we're telling macro stories, but I think it's dangerous to try and tell a more granular story because then you're guessing. Not to bring up the guess word again because that got us in trouble last week.
It's all guesswork, as I explained to you quite clearly last week. Now, you know what this is? What it's like? What the uranium space is like? It's kind of like if you had a pie chart of all the different types of energy that utilities sell, and uranium is one slither of that pie chart. We're describing that slither of the pie chart as the macro story. It's not. The whole pie chart is the macro story, and we need to work out how we fit into it, why we're part of the solution. Because the pie is going to grow because we need ever more burgeoning levels of energy. So that's good news. The pie is getting bigger. And even if we kept on a percentage terms, our 10% or so, 14%, somewhere around there. If we keep that percentage there, we'll significantly increase the demand side, and therefore we'll have to significantly increase the supply side of the uranium part of the equation. So that's all kind of good, but it's a kind of I think it's misguided and maybe even sort of slightly disingenuous to say just describe our little slither in that until we can more comprehensively on a geographical basis, on a time basis, on a cost basis, your return on, investment, etc. basis. Until we can talk more seriously, like adults, about that, it's very hard for us to second guess then what utilities will do in terms of behavior. Second guess where we think that banks, investment banks, etc., will deploy their capital. So I think that's what I'd like to see more of in these conversations. And maybe we can start that. Maybe we can talk to some people and try and understand those sorts of numbers, and we can bring that into some of the conversations in the next few weeks. But that's where kind of slight disappointment here. I am still I've got to pro nuclear and pro uranium investing, and we still hold here, but I'm not drinking the Kool-Aid. I just think I'm into that kind of scarcity component based on our discussion last week around supply, because the existing needs cannot be supplied.
And that's a theme you've brought up many times now, which is that
I do bang on about it.
Because it's many of us will say, well, you can't. There's no substitute for nuclear. There's no substitute for uranium. Well, on a macro level, you're saying there is.
There is.
There is on a macro basis.
But in our, I'm saying in our tiny little slither of our pie chart, there's a whole bunch of infrastructure which needs supplying on its own. Forget the growth bit, just that bit alone. And I don't think that the supply coming up is going to be able to fill that need alone, right? So we're talking macro, nuclear will also take over the world and it'll supply everyone all of the time sort of thing. That's kind of the kind of vibe get off by the kind of bulls. It doesn't need to be that. It just needs to be like, have we got enough to fill the current supply? No. So therefore, there's an opportunity there. If I thought this was a case of we need to kind of grow supply to fill into an increasing need, nuclear reactor need, then that might be a tough one, right? That might be a tough one. So I'm saying, like, if you're going to have a conversation about macro and the bigger picture, then at least, for God's sakes, at least come to the room with the data on that, and then have the argument.
But I think the numbers at a higher level are pretty clear in that we know how much fuel it takes to power the reactors, and we've seen all the wise people come to the table and say, well, here's where all the supply is going to come from over the next 10 and 20 years. And we sat here and go, well, your development numbers are wrong. You're not getting the numbers out of that you think you're going to. You're not getting the numbers out of existing production you think you're going to. Your restarts aren't providing anything. And guess what? For the last 10 years, you haven't been looking for any uranium. You can't find something you weren't looking for. So I mean, from a price perspective, it's gotta at some point. I mean, that's what we keep saying. It's gotta hit at some point in time, because there's too many. There's nothing driving it in the other direction. Nobody comes up with, oh my gosh, we all of a sudden found a warehouse full of uranium we didn't know exist in Kazakhstan, and then it's going to supply the world for the next 5 years. That's not happening. It's all every piece of news we come up with is another slam on supply, and we just don't see it yet in the eyes of the utilities. Panicking, running around the streets looking for uranium. Yet.
Okay. Well, let's kind of maybe have a little whiz over some of the topics we talked about last week when it comes to supply. You were talking, I think, about Paladin, the Heinrich restart, etc. And there's a few others attempting it. Where are we at? Just as a reminder.
Where are we at with them?
Well, just across the board, these kind of restarts, because it's.
I mean, the restarts. Well, Cigar Lake isn't up to capacity yet, up to where they'd hoped to get. Langer Heinrich was, their guidance was 6 million pounds this year, and they had to cut it to 3. And then they had issues at the beginning of the year and have pulled completely their guidance. What are some of the other restarts going on right now?
Well, Kazatomprom with this struggling out there with acid and delays, and
that's right. And the Niger assets are getting shut down. I mean, that's digging into not restarts. That's digging into just normal production. So all of those things are kind of suffering. But I mean, that's the restarts, and then we're on development on top of that. So as we said, anybody who's betting on all of these mines that are lined up coming in on budget and on time is betting against mining history, because that doesn't happen.
Yeah.
So okay. I don't think it's a real slam on any of these companies that are trying to get these things up and off the ground. This is normal. This is normal life. This is what it takes to get from here to there.
That's well said. Actually, it is normal. It's hard. And it's normal for there to be delays because this is highly technical engineering we're talking about, metallurgy, all the things that could go wrong. So things like the price is what we tend to focus on, which is kind of almost the easy bit of the equation. I say that with a smile on my face, but in terms of incentive pricing, all this was a conversation. Okay, I get it. We get it. When you sort of make the decision to kind of try and get things, back on like Cigar Lake, MacArthur River, etc., or whatever the heck's going on in Niger, and whatever's going on at Peninsula. We've also referenced Encore and previously Paladin, etc. It is just difficult, and delays will happen. It's mining, not just uranium, happens across the board. So fair point.
Just another Tuesday.
Point. Yeah. Just another Tuesday. What a great phrase. What are we saying there in terms of the supply? I know we're sort of summarizing a sort of 1 hour conversation we had last Thursday. It's these setbacks kind of will exacerbate the supply deficit for sure. And it comes back to that word I used earlier about the fragility of the kind of current uranium production capability. That's it, folks. And if you want more detail on that, jump into last week's conversation if you haven't already heard it. We'll put a link in the description below as well, so you can get that a bit more easily. We'll look for the the energy show on cruxinvestor.com. There we go. Cracky. Sound like a radio host.
Well, you are.
Which is your thing. So yeah. What are some of the other factors which are sort of maybe, have affected investor sentiment and the kind of market dynamics, do you think?
Well, there's been other things to invest in. Certainly, I think tech took off. There's just been other things to invest in. And again, when you're in the resource space, you're looking at somewhat speculative investment. So you're not betting the whole farm on on a mine coming into production, or one discovery going to be made. So it's we're looking at that speculative money, if you will, and it's had a lot of places to go that it didn't before. And I think so that's part of it. Although I do think that all this turmoil in the markets these days is going to be a bit of a benefit to the resource sector, because it's not being slammed in the same way. We're not subject to the same sort of tariff threats, because we're not manufacturing something that we can move. We can't pick up MacArthur River and take it down to Arkansas. It's so we've got countries who are now supporting domestic resource sector, I think after all the turmoil and confusion of the last few months and where we're heading, it may wind up being a pretty good thing for the resource sector.
Yeah. So other things like ETFs. Do you like ETFs in this space?
Well, I like ETFs in this space for people who haven't got the time to spend researching in detail, each and every one of these opportunities. There's only so much of your show we can watch in a given week and pick up who's who. But so I think they are good. But again, the challenge is they're only dealing with, they're not dealing with the explorers for the most part. They're dealing with the producers and battering them around. And they've actually been problematic in some cases, because where they do pick up some developers or some explorers, and then they shift their book, all of a sudden, it causes a bit of panic all over the place as well. It can cause, share prices to violently rise or violently fall, for no good reason other than they've been shifted in an ETF. But that's not money going in the ground. A lot of this investment money has been going into the Sprots of the world, the ETFs, the Tribecas, whomever, the Yellow Cakes, who are buying up uranium on the spot. It's not going in the ground in any way, shape, or form, and so that's been a problem. And I think hopefully, again, we're all waiting for the squeeze, to come through the door. When it does, that money's got to find new places to go, and it'll come down to us. But it's in the meantime, it's not.
Well, yeah, I think that's well put, actually. For people who haven't got time to actually invest in doing the proper research, ETFs do make a good case. And much to your chagrin, I do often say that when I'm talking to you. But if you don't want to do that, and you want a sort of an idea of how to value these companies, you can go to cruxinvestor.com. We rate these companies with the Crux Investor Index, score out of 10. And by the way, these are not all our clients. I say clients, people who come on our website. These are mostly over 70% of these people who kind of have scored quite well, 7s, 8s, and 9s.
How many of them are exploration companies, Matt?
There are some. Yeah. I mean, I think exploration, by dint of where it is in the kind of curve and its spend, etc., it's more likely to be in the 6s and 7s range than 8s and 9s. There are no 10s. But yeah, there are a few who make a lot of sense because they've kind of found something quite good, or they're going back into something which has previously been understood. So exploration companies are in there.
How many greenfield exploration companies are in there?
Not a lot. Not a lot.
Yeah.
Well, not like, and because our risk profile is really,
really
simple.
No. I get it.
But, like I don't invest on the basis of public talk. Invest on the basis of, there's a lot of data which we can look at off the back of a business plan we understand that's been articulated clearly, with a strategy and a team who can deliver that strategy that makes a lot of sense. So unfortunately for most explorers, it's kind of made up on a day-to-day basis. That's the bit I don't like, because it's risky and it's expensive. And it's not clear. So yeah, you're good point. But anyway, there we go. The Crux Investor Index. Go to our website. Every company's got a ranking. There you go. And if you look at some of the numbers there, we've done exceptionally well. And most of the 7s, 8s, and 9s, you'll have seen, definitely triple digit over the last 5 years. In some cases more. One couple of cases more. So it's all good. It's all good. So let's take a look at some of the other issues as to why uranium investors haven't explorers haven't taken off. Dilution, is that a thing?
Dilution is an issue. It is an issue. It's more of an issue. Like people throw it around a lot. I find investors throw it around a lot. But they don't. They haven't really internalized why. It's just an easy toss out. Well, it's the dilution, but it is a problem because and oddly enough, and I've heard this a lot. I heard this a lot when we were in London. They don't understand for the life of them why investors in North America are so focused on share price and have no clue as to market cap, whereas over in London, that's all they watch is the market cap. And so the problem on dilution is that if your market cap stays steady and you just keep issuing shares and shares and shares, then your stock price is going to keep going down, and that's what our sector suffered since 2021. When all the money started coming back in because we weren't getting the buoyancy in the stock price from the commodity price. And so it is a problem. We've seen it as a problem. That's why we've taken a bit of a different route and that we're partnering all over the place. And I like to think that these large companies aren't partnering with us because of our social media exposure, but I think we're at that point where we have to watch the dilution because it's going to directly affect the share price, and then you won't be able to raise money forever that way.
Yeah, I see. Interesting point. Segue, folks. Speed up and move on. But I've got to say this because last week my guys came back with analysis, and long story short, bottom line is social media is just not working the way it did. It's less effective than it was because there's a lot more of it out there. And there's a lot of horse shit out there, and therefore everything gets it. When you kind of discount stuff when you see it, you sort of go, I do. I sort of go, that's got to be horseshit because there's so much other stuff out there. So the good stuff's getting lost with the bad. And I think companies having to work harder. And we've been approached recently, and we don't do it. Maybe we should. Is more social media, with companies, but it's not what we want to do. We just want to create good content, but they are literally they're companies. And when you see these things, and please, for God's sakes, if you see your company you're invested in, say we've just signed up $100,000 or $200,000 deal for social media, just slap them because it's insane. All of this stuff is created via AI, signed off by a human, presumably. Although doubtful sometimes when I look at it. And it's just going out to, I don't know, pacify your existing shareholders. I'm sure if they
it's more than that actually. It's been a real struggle, and as we said, because 15 years ago, all you need to do is a bunch of road shows and get in front of brokers and dealers, and they would spread the word for you, and that doesn't happen anymore. So there's been a real struggling amongst the likes of us as to how do we communicate with retail investors anymore. We don't know how to necessarily, and we're old. We're old guys, so we don't necessarily, we're not knee deep in social media, understand the nature of it.
Lord. But here's what I'm saying. Let me be clear with you. I'm not arguing over do you need social media. Yeah, do it, but don't go and spend $200,000 on it on a 3-month program. That's pardon my French. That's sodding nuts.
No.
Insane, because it is completely doable with AI. And if you're spending more than $2,000 a month, I think you need your head examined.
You're right.
What I'm saying.
And you're right. You're right.
Right. And it's so much so. So you need your social media, and yes, you need your road shows, and yes, you need your conference, and you need all of the above to reach lots of different types of investors at different places at different times with different kind of cost profiles there. But when I see these things, we've been approached in the last, I'd say 2 months, by a whole bunch of companies. Oh, do you do social media? Could you do social media? I think the cheapest group was saying they're paying £10,000 fees, not for the advertising, not for everything, fees for doing this. So if there's media companies out there, they're just having just Christmas every day for them, because you got, as you said, you've got these old guys who don't know anything about it, or the technical guys who don't know anything about it, whether it be financial or explorers, and they're being absolutely bent over on this one.
Right.
That's a technical phrase. For these companies, and I just think, just sort it out, create better content which actually does a job that will be picked up and passed on, etc. Do your social media bits and bobs, but not 100, 200. With one company who was saying it was a $10 million company. $10 million company. They raised, I think it was, they raised $2 million, and they spent $400,000 of that on a social media program for 3 months.
Yeah.
Their stock did go up, and it went straight back down again.
See, but the problem is they're blowing it all on advertising that's not focused, right? And so if you're doing a proper social media program, what you're doing is cheaply, right, is collecting the base, is getting those narrowing down your demographic, so that when you go out and spend $100 a week or something on advertising, it's going to exactly the right people. A lot of these people are being sold on, give me $3,000, $4,000, $10,000 a month, and I'm just going to blast out all kinds of ads and things and whatever. But you're spraying a hose over an ocean.
It's spraying a hose, absolutely.
It does not require that kind of investment by any means.
Nope. Think about it. Sorry, we segued into something that's driving me nuts at the moment, because these are companies that I've invested into too. If they asked me, I would say, don't you dare. Absolutely not. Do not do that. Anyway, we should get back into the program now. Sorry, folks. Segue. Right. So fears of dilution, clearly part of it. The big obsession, obviously, was always around spot price. No amount of telling will change people's view on that one, will it?
No. The spot. I mean, the spot. It has to start reflecting what the reality of what's going on, in the background. But because it is so, the liquidity just isn't there. It continues to be somewhat, fluctuating all over the place. So, my hope is that it will gather some momentum and at least track on the long term a little better than it has been, because that's been throwing everybody for a loop. Way overshot the long term, then now it's way undershot the long term, and I mean that's not helpful when that's all people are watching. So yeah, I think the spot does need to get tightened up as part of this exercise of being able to watch the uranium market and when it's actually happening. Okay,
so just sticking with this whole theme of why the uranium explorers haven't taken off yet. We said it earlier, we're in agreement. There's lots of different ways to kind of play this market, different time frames in which you can play this. Do you think that for the equities, kind of any hope of being taken seriously in this tiny little market within a tiny little market, uranium within the tiny market of mining, there needs to be a whole bunch more M&A? Is that going to solve the problem?
Well, that's what this is going to turn into, right? It has to. I mean, the good ones will get scooped up. I mean, we're the ones that are out there looking for the new product, and that's where the majors are going to get it. There's going to be M&A in that regard. I don't think you're going to see a lot of junior exploration companies merging, because that doesn't seem to help anything when it comes to investors. So M&A on that end of it, no. I mean, from an exploration standpoint, we just need to see companies who are approaching this market a little bit more surgically, rather than just treating it like I'm another copper explorer or a gold explorer or something like that. I mean, this is uranium. So it matters where you're looking. It matters how you're looking. It matters who you're partnered with. It matters, what you're finding along the way. All of these things matter. What doesn't matter is somebody just sold me a piece of property in northern Saskatchewan, and yippee-i-o-ki-yay. It's got to take more than that. They're out there. We're out there. That's what it's about. These companies have to show well, because again, at the end of the day, we get re-rated when we have a good hole, and that good hole could be tomorrow. And but it has to be, if it's really going to get value, it's got to be aligned with somebody who might take you out, which is the real end game here.
Right, but so what's in the hands of the junior explorers? How can they best position themselves? Because there's a kind of risk of macro trend at the moment, which kind of delays institutional capital rolling into juniors at the moment more broadly, and even within the uranium investors, whether it be specialists or some of the generalists that have are milling around. It's difficult for them to ignore everything else that's going on out there. They don't just have uranium to invest in. They've got lots of gold's gone on a tear again. Before that, last year we had gold coin going on a bit of a tear for a bit, and the tech guys and gals maybe they're going through a bit of a rougher time at the moment. Oil's come off a bit. I'm trying to think. There's a lot of things that are going around which they're sort of looking at and going, well, maybe there's opportunities which will move quicker than uranium. So when do you think this kind of risk-off attitude to uranium is going to maybe?
I'm getting very tired after years and years of saying, well, it could be tomorrow, because that's the reality. And every day that that spring gets tighter and tighter, where do you go with it? I remember my dad had a service station we were young that we used to work in, and he had this magic formula for selling fan belts. So you'd get under the hood, which was a challenge in and of itself. When you'd get under there, if you got a fan belt with a crack in it, you knew you had. So you'd go tell the guy in the car, you say, I think you got a problem here. The minute you use the word problem, they get out of their car, they come and they look under, and you'd show them the crack. And they'd say, well, how long would that last? And you say, well, it might get you from here to Toronto and might not get you off the lot. And that's kind of where we are with this as well, is it could be tomorrow. It might be another year and a half. It depends on numbers that we don't see, what the utilities are sitting on, where they're currently contracting, where they're currently buying from, what they've got, already contracted coming in the door. These are all things that we don't know and we can't see. But what we do know is that, we're using uranium a lot faster than we're finding it, and it's going to take money. So there is a squeeze coming. Price is going to go up. Money's going to come in. It can't not happen. The challenge is we haven't got the visibility to determine exactly when is that right time to be getting in.
Well, I guess it's like, that's my kind of fascination with producers or near-term producers, is that they will tend to re-rate first because they're the ones that are going to be selling, making actual money, adding money to the balance sheet. Really, really, really helps. And then explorers tend to follow that. So in that kind of, what do we call late cycle, don't they?
That's right. Yeah, they'll re-rate a little later. And which is fine. They're at that point in time, they are caught up in the tide that is rising, albeit a little later. And then hopefully with the money coming in, there will be a discovery, which is your big re-rating. So it's can you make it to a discovery? Have you got the legs? Have you got the runway, the money, the ability to make a discovery? And then because that'll get you a re-rating first out of the gate as things grow, and then you got to hit something, and that's the big one.
Honestly, I can't blame retail investors to be slightly exhausted,
frustrated, exhausted.
Right? Yeah. Get the thesaurus out, folks. It's gonna be a long one. It's been a I think super interesting ride from an intellectual perspective in trying to understand how markets perform and what drivers are, and who knows what. I think I said it to you last week. So the amount of people who just clearly the last 5 years have been talking out their ass about the space, because we're all learning on the spot, right? But it is what it is. Should we just kind of maybe kind of finish off in terms of maybe anywhere they're kind of positive. So let's give reasons for, why we think, if you remain investing in uranium or start investing in uranium explorers, given that sort of time frame. We give us some clues already. Maybe it's a reminder. It's a long ways. It's a long journey they've got to go on. But why would you invest in uranium explorers? Why would you continue to?
Well, and again, I focus on Saskatchewan because that's where we're from. But as we pointed out before, there's a new discovery made every year and a half. It seems when in the normal markets, there's been a lot of money spent in the last few years, enough so that we're due for another one. And if you're investing in these exploration companies before, after the discovery, you've missed the big money, because that's the value proposition in the exploration we do. So it's it's uranium. It's, in our case, it's in northern Saskatchewan and the basin where it is, and there's a lot of money going in the ground right now. So you want a piece of that, and the macro model, as we keep talking about, would say that when it happens, it's going to be potentially violent. So when it comes, it'll come.
And you say that why? Based on what evidence?
Because it always does. I mean, when it moves crazy. So, I mean, it did back in 2004, 2005. It went up like mad, and then it came off when all the banks blew up, and then it started to come back again madly, and then Japan took on a tsunami that took it out. At the end of 2023, we saw spot prices take off, and the markets went off with it. But if you look at those companies, if you look at the explorers and the ones that are finding stuff, you look at the Hathors, the UEXs, all of them historically. You're talking, when there is a discovery made, you're talking 10, 50, 100. In the case of UEX, it was 1,000% return. So that's the return you're looking for. I think this market is highly supported by a variety of factors right now. So it's not you're not just rolling dice down a hill, and the high risk, high reward kind of thing. But I think the reward in this particular case is historically demonstrated that crazy money to be made. Next gen, fission, they're the other ones I didn't mention. ISO energy. You hit something, and you've paid for a lot of bad years.
Okay, and mind the jurisdiction, folks. That'll be
mind the thing. Jurisdiction.
Mind the jurisdiction, folks. Well, I'm sure there's a bunch more we can talk to. But it seems like I think we continue to say uranium explorers offer good upside potentially in a tightening market. It will kind of lag the producers, but it'll be sort of late cycle, and that's all fine. So what have we learned today? We've kind of talked about kind of structural challenges in uranium supply. This and last week's show, I think that was that's been a good reminder. I think if you don't have the time to kind of do the work, go to cruxinvestor.com and look at the index there, or put the time in. I'd urge you to, and sort of see if there's anything from today or any of the shows I've done with Chris, which sort of give you some clues as to what to look for and what to avoid. And if you can't be bothered, I mean, go get it, go do some ETF investing instead, because it'll take a lot of pressure off of you, and you can blame them, not yourself. So I think maybe next week or next no, you're away, aren't you? You're
away next week. I'm away next week.
Oh, unbelievable!
I'm sorry. It happens.
We are going to come back and we're going to maybe talk about some of the exploration companies. We're kind of group them together and look at what we like, maybe what we'd like to see from those companies if they are to kind of move forward. And sort of have an honest conversation about, like I say, mining's hard. This isn't like kind of gotcha situation. It'll just be a case of like, this is where they're at. This is what they've got to do, and this is what they would like us to believe that they can do, and we'll give them the time to do that. and hopefully people find that interesting. Maybe some people will be pissed off, but such is the nature of conversation, dialogue, and debate. Enjoy your holidays, sir, as well.
Thank you very much. Thank you very much. I'll send you a postcard.
Say hello to the missus.
I will, as always.
Okay, as always. And see you soon.
Take care.